What's going on, guys? This is ONF, and today we have a very special video for you, the 2024 Bull Run Ultimate Playbook. So, as many of you know, I've been in the space for 7 years. This is my third bull run, and I essentially just wanted to impart as much knowledge and secondhand experience as possible to you guys so that you can go out there and tackle this next bull run as best you can. And yeah, really maximize on your profits throughout this year. Now, before we crack on, just need to get the formalities out of the way. This is not a signals channel. The content here is purely educational. I am not a financial advisor, and the content in these videos is not financial advice. This video is also not intended for the residents of the UK. So with all that said and done, let's crack on. What I've put together here is a comprehensive approach and system in how to tackle the upcoming bull run. I'm confident that if you watch this video until the end, you'll have a much clearer understanding on what you should be doing this year, how you'll be able to best capitalize on this upcoming alt season, and as opposed to just sort of guessing and sticking your finger in the air, be able to lay out and think through a much more systematic approach to maximizing value as best you can. This video is broken down into 5 parts, and we start off very importantly with number 1, assess your edge. Are you a trader, an investor, or both? Honesty is critical here. Be real with yourself. You should only be trading if you have a track record to support that decision. Realize that most would benefit counterintuitively to a hands-off approach, and unless you are a very experienced trader, let the current carry you. At the least, if you do choose to trade and you don't have years of track record to support the idea, then you should wait and only take longs when everything is clearly in easy mode. Moving on to number 2, but before I do, I'd like to ask all my viewers to please like and subscribe if you haven't already. Hit the notifications bell, and please leave any comments on what you'd like to see for future content. I'm here to help each and every one of you, so all feedback is super appreciated, guys, and would love to hear your thoughts on this style of video. So once you've had a good long think about point number 1 and been really honest with yourselves, we move on to point 2, which is deciding how active or inactive you want to be and setting this decision in stone before you embark on your journey. Is this your full-time hustle, or do you work a job and this is a side earner for you? Now, as you can tell, it's very similar to point 1. Essentially what we're doing here, guys, is just trying to set and work out some parameters for you, and only you can answer these honestly, but you have to be honest in your answers because ultimately this will shape how best you profit from the upcoming bull run. Now, let's dig into this a little bit further. If you chose inactive, then the approach that would best suit you is to buy and hold the projects you believe will outperform and keep a vague eye on the market with the idea to start paying more attention in 6 months' time as per your exit. This isn't to say you exit in 6 months, it's to say you start paying more attention. For most, this is the best strategy. Many think increased effort input equals increased financial output, but the reality for most is less is more. Now, if you said to yourself in the last slide that you were going to have more of an inactive approach, then please heed these words, guys. The best thing you can do is invest, sit on your hands, and come back in 6 months' time. What I don't want you to think is something that I thought for many years is that, if you're not doing anything, then you're not going to get the gains. And I can tell you guys from personal experience that during aggressive crypto bull runs, many investors and position traders outperform a bunch of people that are hyperactive in the markets, okay? Please believe me when I say that the reality for most is less is more, okay? Now, if you had said in the previous slide that you were taking a more active approach and this is your full-time hustle, then I have one thing to ask of you guys. Write out your strategy. Now, I want you to try and get this down to one clear and succinct sentence, and this will really help map everything out for you guys, okay? Essentially, what we're doing here is just writing down our mission statement, and it's incredibly important to get it in writing, as this will be your mantra for the bull run, okay? And by having it in writing, you can see whenever you're deviating from your plan and just simply return to it, get back on track and follow your objective. Now, to lead by example, I've written mine down here if it's of any interest to any of you guys, and it's to hold a portfolio of my chosen fundamentally strong mid and low caps, trade the highs, and filter these trading profits into new launches as I go, using my PCVS system to time my exit. Now, don't worry guys, I don't expect any of you to know what a PCVS system is. I'll be covering it off towards the latter end of this video. Number 3, and this one is really only for the active participants. Determine your rules and desired portfolio split. I would suggest that unless you are an extremely experienced trader or player on chain, your best approach is adopting the following portfolio split, being 70% alts, 15% stable coins, and 15% Ethereum. Now, this is the best blend I've personally found over the years. And if we move on to the next slide, I'll break this down in a bit more detail for you. So we have our 70% and majority of our portfolio in altcoins. This is comprised of long-term bets on projects varying from lows to mids, only investing in lows or micros if they are truly irresistible and doing so lightly. It's good practice to earmark a 3% max allocation of your total portfolio to these smaller caps. Don't get wrapped up in how many X's this could pull without factoring in that these are high risk plays that you can lose all your invested capital on overnight. And also realize that these will take the longest to play out due to the trickle down effect. BTC first, then high caps, then mids, then lows, with of course exceptions. You can start scaling into lower caps more so as the cycle progresses, as their time to shine will be towards the end, generally speaking. You must in advance define those that are must not touch alts in your portfolio, and you will naturally break this rule if they start hitting crazy multipliers, but at least it means you'll hold off until the gains are truly irresistible. Then the remaining part of your portfolio is 30% across ETH and stables, and this is just in case we get any severe dips across the board. And this is the best balance I found between having max exposure in the time you should and having some dry powder to be able to feel like you're taking advantage of dips, but most importantly, viewing these as opportunities, not problems. Now, please guys, take it from me. It may feel like the best approach is going all in and having max exposure, but you've already deemed yourself an active participant in the markets. And as a result, the best way you will perform is being nimble, liquid, and ready to attack any situation that presents itself. 30 to 40% corrections are commonplace in bull runs, and you need to have at least a little bit of dry powder to capitalize on these moments. And just remember guys, you're taking part in an incredibly rare wealth creation opportunity, and you should be enjoying it. And by adopting this split, you'll make sure to maintain a positive outlook throughout the whole experience. i.e., when things are going up, you're very happy because you've got the majority of your portfolio exposed to the market. But vice versa, when we do have those flash crashes and corrections, you're well prepared and able to capitalize on those opportunities as well. On to number 4, and this one is again for the active participants only. Recycle partial profits as your holdings start going parabolic into new launches as they occur throughout the year. Again, define whether these are flips or must not touch coins dependent on their fundamental analysis. Remember that the biggest gainers of each and every cycle are new coins. This market is still hugely driven by hype and speculation, and the hot new runners are where you want to both be initially positioned and dipping into to maximize value as the cycle progresses. Now, this one is true time and time again every cycle, and people often think that they need to prepare their portfolio in the bear market. And of course, if you time it perfectly, then doing so is hugely rewarding. But just remember guys, every cycle, the biggest gainers are the hot new topics, flavors of the month, and new launches. And like I've covered off in recent videos, you're never too late as there's always new launches. So my best advice is to position yourself into these new coins, and then as they start going parabolic, take partial profits and recycle these gains into other new coins. Now we're coming into the last section of the video, number 5, and this one is both for the active and inactive participants as we're trying to time our exits. Now, 99% of new investors and traders in the crypto space do not think about the exit in advance, and that's something that I really want you guys to change right now today. I have personally found immense value in planning exit strategies in advance, and although you may not want to focus on this right now, I promise you will not regret doing so. And I'm talking very much from personal experience here. I have personally and seen many others hold their coins all the way up and all the way back down again. And I promise you that putting these systems in place will truly help you guys come out with much more in your hands and your pockets. And to best do so, I've put together a very diverse system called the PCVS system that I touched on earlier. And essentially it stands for personally based, chart-based, valuation-based, and socially based. Now, what do these mean? Well, personal is simply selling into euphoria and also when the amount you've made seems outrageous to you personally. This may seem like a silly metric to determine your financial decisions off the back of, but honestly, guys, I've seen a few people pull this off in the past that have just walked into crypto, exited when they've made a ton of money relative to their personal circumstance, not been greedy, and none of those people have ever lived to regret it. Next, we have chart-based signals such as higher time frame divergences on BTC, deviations, or aggressively selling into parabolic increases. So again, to lead by example, I'm going to show you how I exited the last cycle based off the chart-based signals on the higher time frame. And here we're looking at Bitcoin on the daily, okay? So you can see that we had this first rally up, we came back down and went for another higher time frame leg up. As we did so, we took out this swing high here, and then we took out this local high yet again here, okay? So here we have a higher time frame sweep of a historic level. Then we have a local sweep up here, and look what happens as we do so, guys, okay? We can see clearly on the awesome oscillator that momentum drop off as we make this increase. So we have the candle bodies making a higher high and both oscillators clearly making lower highs, okay? Now, I'm not going to pretend like I exited at the Pico top up here, but I started to scale out of most of my positions in this area here as we started to get deviations and confirmations of closes underneath this level on the daily. Then I exited the remainder of my portfolio as we started coming down and closing here on the daily, as we clearly lost this low, which is a loss of higher time frame market structure and a clear sign on the higher time frames of Bitcoin and subsequently the rest of the crypto market's intention. Next, we have valuation based, which is predetermining what valuations you would expect your individual projects to hit in full bull. I would suggest erring on the side of caution and using historical and previous valuations from similar projects in the last runs in order to reach these figures. Now, lastly, social, and this may seem incredibly random, arbitrary, and outright stupid. But honestly, guys, I've seen it before. Some of the smartest investors I know take social metrics into their decision-making process. And essentially what I mean is just seeing the people around you or on social media start arrogantly flashing stupid amounts of cash that they've made, whether this is in the form of, cars, watches, P&Ls, whatever it is, that it's honestly some hidden alpha here, guys, okay? And, this can take many forms. I remember clearly from the last cycle, there was one day that really had an impact on my exit plan, and that was simply that in the same day, a number of my friends reached out to me about investing in crypto. Some of my more distant family members did the same, and I took an Uber that day, and even the Uber driver was talking about how to get into crypto. Now, this may seem like a completely wish-washy approach, but honestly, guys, there is some hidden alpha in thinking this way. Pay close attention to the people around you, friends, family. Pay close attention to the signs you're seeing on social media. And, if you don't have a rich social circle, that's fine. You can use more quantitative social data, such as, for instance, Google search trends. But again, history repeats itself time and time again, and at the top of these cycles, you will always see flocks of retail trying to pile in at the top, arrogant flashing of cash, and general predictions for much, much higher. Now that we've gone through the format of the exit strategy, you need to determine your weighting. For instance, with evenly distributed weighting allocated to each You would exit 25% of your portfolio when you felt the amount you have made seems outrageous to you, 25% of your portfolio when you saw the necessary higher time frame signals to do so, 25% of your portfolio when you started hitting the expected exit valuations you had predetermined for your projects, and 25% of your portfolio when you start to see obnoxious and arrogant boasting of profits or other social-based top signals. Now, the split that you need to allocate is completely personal and up to you guys. If, for instance, you're an experienced trader or chartist, you could weight things more so towards the charting exit. If you're wisely humble in your ambitions, you'd weight things much more so to the personal targets. And likewise, if you have a deep understanding of valuations and fundamental analysis, then maybe you skew things a little bit more towards the valuation side of things. Personally, I'm planning on operating a 16.6, 50, 16.6, 16.6 basis, exiting the majority based on the higher time frame, chart-based signals, but still using the other three variables as exit triggers. But again, this is me playing to my strengths. For most, I would recommend a 50, 16.6, 16.6, 16.6 strategy, skewing weighting towards personal gains. So there you have it, guys, the ultimate guide to playing the 2024 crypto bull run. I hope this has imparted some value to you guys and at the very least had you thinking about a few things. Just remember, guys, that by watching this video, you're already taking the right steps. You're at the beginning of a truly beautiful and rare wealth creation opportunity. But look, don't stress out about it. You can only do your best. And yeah, my best overall advice, just go out there and enjoy it. As always, guys, appreciate any comments in the comments section. Let me know if you like this style of video and if you found it helpful. And if anyone has any questions at all, please hit me up and I'll get back to you as quickly as possible. So with all that said and done, have a lovely day, guys, and I'll catch you soon.